People will start blaming you. What is this old man doing?
Won't you go and rest?
Oh, God, what were you doing all along? You understand? So that is where the thing now, the whole factors will start coming in and say, okay, fine. And it will show whether you have done well or not.
You become a good or a bad example.
Exactly.
Down to your lifestyle, everything. Yeah.
And the essence of this planning for retirement is to be able to maintain the lifestyle you are living now when you retire. You must invest where your return should be more than inflation rate. Parents to understand that training your children is just your responsibility. It doesn't mean that they have to come back and take care of you. And that's why you have to plan.
Good to be back. Today I'm with my 5 and 6 or wingman, Idika. Idika, welcome back to the studio.
Good morning.
Welcome back.
Good morning, Ogiva and to our listeners. It's good to be back.
Yes, definitely. So today there's someone in the comments in one of our shows, and the person was like, we keep on talking about finances, we keep on planning for the future per se, but we've never really spoken about retirees and how they can, actually plan for it and generally secure the future after work. So today we're looking into investment strategies for retirees in 2025. And Idika, is going to help us generally address that and trash that out.
Well, let me just tell that person that sent that message, and to every other person that is listening right now, that, while it is good to discuss that now, I'll say it is good to discuss that again. Yeah. Because we've discussed it like twice, 2023, and I think we did it sometime 2024.
Yes.
So it means that that person needs to be going to your YouTube pages, your X pages, your podcast more.
Definitely.
There's so many things you can learn if you visit this podcast. But again, Idika, knowing who he is, I'm very sure will bring an angle today that will make people like me want to retire.
Yes. After this episode, you will retire, Kayode. You will retire.
Let me retire to
we're actually even going to break it down, so the layman can understand.
The benefit of everything.
Yeah, exactly. Exactly. So I'm going straight into it. Okay.
Yeah. So I mean, we'll get into that.
Yeah.
That discussion shortly. But when you look at, before we get into that, just a quick question about this. Our inflation is dropped. Is it for the fourth time? And is that some good news? Is it, the other time we spoke about, it was, what do you call it? Not food inflation went up the last time, but the headline inflation is actually what dropped. Before, if you can do that for 2 minutes before we get into this retirement stuff, what does that mean? Does it mean life is better for us? Can we touch on that?
Yes, I think you are right. Inflation has dropped. This is the fourth consecutive time it's dropping, and now at 21.88% from 22.22% in June. Yes, it is good. Let me just put it, some people just say, okay, we are just hearing statistics, we are just hearing figures, we are not seeing any
change in reality.
Yeah, we're not seeing any change, sort of. Yes, the drop in inflation means a lot. One, it controls how the central bank reacts to rates. So if the inflation rate is dropping, definitely that will now encourage central bank to cut the MPR.
Yes.
And if the MPR is cut, that will bring down the cost of borrowing. And that will now bring down the cost of funding even your activities, your businesses. And that will go down. If the cost of borrowing is down or declines, then it will definitely affect everything. Both the people that even corporate organizations, their businesses, you know, that they will come down. So on that angle, yes, it is good. It doesn't just reflect immediately. Gradually, it starts coming in, start impacting. So for it to come down, yes. Because even at that, even your investment too, if the inflation rate is not down, and you make an investment and the return is less than that inflation rate, it means that you are losing money. So that's another measure to measure how your investment is doing.
Okay.
So it's very, very key. It's very, very important that it's coming down.
It's really key, and it actually relates to what we're even looking to talk about today. So, but just so the audience has a clearer view of what we're trying to hit, really, why is retirement considered a season of rest? We know it's a season of rest and financial security, right? But what threatens that comfort in Nigeria?
The same thing he just mentioned now. The key thing is inflation.
Inflation, yes.
That's the key. It threatens, just very simple, it threatens your retirement plans. No matter how well you structure, if the inflation is still high, then it will now erode your purchasing power. But the thing is this. People, once you hear people retiring or you want to retire, people think that it's only when you are old that you retire or you start planning for retirement. No,
big mistake.
It's a very big mistake. I think one of the things President Obasanjo did, which is very, very important, is this contributory pension scheme that he introduced. That is Pension Act of 2004, now changed to 2014. It's very, very key. That means even as you are working, you'll be saving at the same time.
Automatically.
Yes, they will deduct a certain amount from your salary and then contribute and pay. So it's not a matter of when you retire, you start looking for, okay, pay me my money or something like that. This thing is now warehousing your retirement savings accounts by pension fund administrators and managed by pension fund custodians. So that is very, very key. That's a very important thing that he did. And most people don't even understand. It's only when you get old that you figure it out. Now, coming to retirement, why it is important. Givers, you and I are still young.
I'm very young.
Yeah, nobody can really say that giver has not done very well. You can, because you are still young, you have opportunity to still make it. Even Kayode, nobody can say, okay, nobody can.
Kayode is older than me.
Yes, as
yeah, you say I'm not young, I'm young.
Nobody can qualify him as that he's not doing very well. But by the time you start going down, and by the time you get to 60, 65, there are certain things you cannot do again that ordinarily you could have done now. So that is where the retirement sets in. And that is where it becomes so obvious whether you have done very well or not. So that is why it is very, very important that right now that you should start planning how to retire. And that is the sense of this. I think that's what you really want.
Yes. So, I mean, what he said triggered me a bit, I understand the idea of retirement. I understand, but retirement actually shows how well you've done.
Sure. Yeah.
So you can be whatever it is you are now.
You can claim anything you
when you get to retirement, that is when you know how well you've done. Yeah. So, and
that is the engine. That is the main thing.
Yes, exactly.
So there are certain things you cannot. Like now, you can afford to trek from here to somewhere else. And then once you get old, even if you are taking, people will start blaming you. What is this old man doing?
You want to go and rest?
Oh, God, what were you doing all along? You understand? So that is where the thing and the whole factors will start coming in and say, okay, fine, and it will show whether you have done well or not.
You become a good or a bad example.
Exactly. Down to your lifestyle, everything. Yeah.
And the essence of this planning for retirement is to be able to maintain the lifestyle you are living now when you retire. That's just the key thing. So if you are earning 500,000 naira now, by the time you get to 60 or 65 years when you are about to retire, you should be able to sustain that lifestyle. Sustain that standard of living. That is just the key thing. That is the essence of you planning. Even at 30, you start planning.
You should.
Which one maybe as we go on, we'll look at it and see how you are going to do it.
Yeah, it brings me to my next question, really. So to achieve this, right? What guides, should every person use towards saving for investment? I mean, like the golden rules.
Okay.
What the person.
That's a very good question. Look, I think you look at the two golden rules. One, you must, whatever you are going to do, where you are going to put your money must be able to beat this inflation kind of mention. So if inflation is 21%, all your investment must give you return more than 21%. Otherwise, you'll be losing money.
Period.
That's the first golden rule. The second rule that you must balance risk and reward. Of course, in investments, there are high risk investment with high return. So you must balance two of them so that you don't lose money. Those ones that are of high risk, you look at the rewards. Those ones of the low risk, you look at the reward. So you balance it. That will not take into the angle of trying to create a portfolio that will now inculcate and take care of all these things. One, you must invest where your return should be more than the inflation rate. Secondly, you must balance the risk and the reward.
Yes.
Because I know at times you're talking to us and say, no, there is an investment. Somebody just brought an investment to me. It's going to give me 200% return. Of course, automatically it is a red flag for you.
Yeah, that's too good to be true.
Do you understand? It's a red flag for you. So you cannot, when you are planning for it, you cannot take your money and go and put into such asset class or such investment, an investment. Definitely, you are creating problem. You are trying to create problem for yourself.
So that's balancing the risk.
Yeah, so you have to watch it. So that's why we are going. Okay, this one is high risk. This one is low risk. How do I balance it?
And talking about high risk, I would say that I have a personal experience talking about this high risk stuff. I have an auntie who is a fashion designer. She's in her 80s now. She was so good back then and so popular. Our office was next to Dakova in the 80s and 90s.
Yeah.
They were competing and all that. She did wedding dresses for top people and all that. But she invested, bought some property to expand business, blah, 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 put in a whole lot of her money. She was duped until she didn't recover until she retired.
Wow.
Yeah.
She didn't. And that's, so, and I'm aligning it to what you said about taking high risk. Now, thank God she trained her kids well. Kids are all over the world, and she had a house and all that, and with the husband, they're the ones, that is what she survived on. If I doubt if not for the success of the kids, I doubt she would not have struggled.
Yeah.
But she was big back then.
Can you imagine?
I mean, comparing her with Dakova, they used to see each other. They were around the Apapa Road axis there towards Oyigbo. So what you're saying about high risk is important. But then again, in order to avoid high risk, which investments can one get into right now that is above the current inflation rate?
Okay, that's an important. That's the key.
Because he wrote it in his article.
Now, look at what you have to do, because we are coming down now. We have 3 strategies.
Yes.
What we call aggressive strategy. You have moderate strategy. Then you have conservative. Now, the aggressive strategy, you look at if you are between 40 and 50 years. You adopt that strategy.
I need it.
Between 40 and 50 years. Let's use that because now you are nearing your retirement. You are planning to retire.
Yes.
Now, that aggressive strategy means you have 3 asset classes. You have the stock, you have alternative asset, then you have fixed income. Now, if you go to the stock, you now allocate 50% of what you want to invest into equities, into stock. And into that stock, you have to look at dividend-paying stocks, blue-chip companies, like Seplat, Dangote, especially the banking stocks.
Because they are not going anywhere.
They are not going anywhere. Not only that, they are not going anywhere. At least they have been steady. They have been consistent. You don't go and pick stocks that has that are not too known, as you don't have good fundamentals. That will give you problem. Because remember, under this aggressive style, it is the stock that is driving the portfolio.
Yes.
At 50%. Because now your target for that aggressive, that your portfolio should give you 40%, which is what they say, which is above that inflation rate. That is a target.
That's your target.
That's the target return. Should give you 40%, and the asset class that is driving that portfolio is the equity, is the stock. So you have to put in 50% there. Then alternative assets, you put in 20%. 25% means real estate, private investment. Like they mentioned, and somebody called you, say, okay, I have this business. Let's do it together.
Yes,
That is private investment.
Investments.
Then make sure it is not more than 20% of whatever you want to invest. That is what we call is for diversification. You're trying to move at least to hedge against inflation.
Yes.
Then the third one, which is fixed income. Then fixed income, you allocate 30%. Remember, fixed income is government treasury bills, commercial papers, mutual funds, all of them, commercial, all of them come under this fixed income. That one is for stability. That will not give you stability from the fluctuation of what? Of the stock and what? Alternative assets.
Yeah.
So that's the first one. The target is what? 40%. Now go to moderate. Moderate, then moderate is between 50 and 60 years. Now you are coming down.
Yes.
Reduce your position in stock to 35%.
Okay.
Maintain the 20% in alternatives. Then increase your position in fixed income to 45%. You can see you are now balancing. This one is going up. You are in fixed income because that fixed income mainly for stability because it's safe, low risk, though low return. But the essence of that fixed income in the portfolio is for stability.
Yes.
Then you use the alternative to play around. Okay, I'll give somebody. Okay, I have this business. Can we try it?
That's how it goes.
And that's how it goes.
Might be
that one just like can you use it to kite to play around?
Yes.
Then under stock, you make sure that you put about 35% of it. Then make sure that is where your investment advisor comes in, because stock requires absolute monitoring.
Yes, it does. It does.
You have to monitor it. You know, some people will just invest. Okay, and say, okay, I have stock. Even some of them, when they ask, okay, bring your evidence or even your certificate.
They don't have it forgotten.
So no, it doesn't work that way. So if you cannot do it, get your financial advisor to manage it. It requires a good management. Then the last one, which is the conservative, that is when you are going down between at least 60 to 65 years. You can now increase your holding in your fixed income to about let's say maybe 70%. Because now you don't want to lose money.
Yes.
Because you can't afford. Because if you lose money, it will affect you.
Your back is weaker. BP. High BP.
So you take that one to 70%.
Yes.
Alternative 10%. Equities 20%. Then in that equities, what you do there is focus on only dividend paying stocks. That can give you regular income. So once they know some of them pay biannually 2 times in a year, like the banking stocks, some of them pay 2 times in a year. After first half, they declare dividend, they pay you. End of the year, that is the following year, when they declare close for the year, around January, when they declare their result, they pay another one. You see, that will give you stability.
But I mean, you've listed a couple of investment options. I don't know, but nowadays you hear a lot of people in their 40s to 50s, even people in their 50s, saying they are going into FX trading. I have a friend who told me that, I mean, during COVID, he said when he had just about 5,000 in his account, he didn't even know where to turn. Thankfully, from nowhere, government gave him the 200,000 naira. He was shocked that he could even get that because he didn't know anybody. He said then he went into FX. That was FX trading that saved him. Is FX trading a viable option to plan for retirement? So that even in your old age at home, you could just do the trading and be making the little peanuts and survive on that.
Yes.
Alternative, right?
That is correct. You are correct. It comes on, you are getting it. It comes under alternative. And I'm giving you the percentage. You understand? Under alternative, if you are aggressive, remember alternative is 20%. Under aggressive strategy.
Yes. 20%.
It's 20% under aggressive strategy. So you can put those Forex, gold. Commodities, all those.
Because the risk is also very high.
Yeah, the thing is so very bad. It can give you a hedge against inflation.
Yeah.
You can use it to hedge inflation. Do you get the point? So, but the only thing, the concern is that what is the allocation to that particular asset class? And I'm saying, if you are aggressive, if you are still young, you can put 20% of your investable fund into the alternative assets. Put 50% in equities, 30% in fixed income. Fixed income, you can go for commercial papers that can give you almost 22 or 23%. So that will equally, by the time you structure it very well, you can even exceed that target of 40%. Because there's a way you play, you place your alternative investment. You can make
or break you really.
You can even get even more than that 40%. But what we're saying is that there should be that risk return matching. Very, very important. So that you don't lose your money. Because remember, we are planning to retire.
Yes.
So that you don't rely on your children.
Yeah. And like going back to what you said earlier on, I actually saw a post on social media a couple weeks back where a mom was complaining about having a discussion with her daughter, and her daughter told her that she's not going to take care of her. You know, she said she's not going to take care of her. That is not by force. You are the one that gave birth to me. I didn't ask to be.
At least that's your responsibility to take care of me.
And the mom was, shocked.
Yes,
she was shocked.
She shouldn't be. We have not trained the children of this next generation. We've not trained them to be family oriented.
Yes, I agree with you.
Individual.
Selfish. I will use the word selfish, and I don't mean there's nothing negative about it. Really. It's selfish. The word selfish is, the context can actually,
like self-focus.
Yeah, so selfish is them.
I think the better option is for a parent to understand that training your children is just your responsibility. It doesn't mean that they have to come back
take care of
you. And that's why you have to plan. So even if you plan very well, you can equally control what they do, even at that retirement age. Because what happens is that because you are not independent, you are not on your own, you cannot do things on your own. So whatever they dish out to you, you take it.
You take. You don't have any.
You don't have any. So
you go back to
the way they were. So that is why it is very. That is why it is very, very important.
Pocket money.
Even if at age 30. You can start planning. Because if you are 30, you can even increase your allocation to equity to about 80%. Because yes, you can afford to, you are young, you can afford to play around. By the time you start getting to 40, you can now drop the allocation to 50%.
But just to add, discuss this further. So if you're saying 30, you could increase your risk appetite at that age. So which means that if you're in the university, it's actually a good time to start investing.
Sure.
So that there you could take out the risk and then master the process of investment.
Sure.
And by 2030, you become
a guru
advisor.
Really. Let me tell you, if you don't have any outlets, you are working, you don't have any outlets. I bet you if you come out, maybe you are working and you retire and you come out, and maybe they give you bulk money, say maybe 20 or 30 million naira. And if you don't have any outlet where to put that money, don't have any, that you don't have any business, don't have any investment, I'll tell you, if you come out, the system will collect half of that money first. In the process of you learning. By the time you realize what is happening, half of the money
is gone. 30 million is nothing these days.
You understand? So that is why even when you are young, even at 30, when you are investing, you start building. Like Kayode said, have that course. Now it is very easy to trade. Because you have your apps. You can, even at low as 5,000 naira, you can take a position. You can open a money market mutual fund with any of the security firms and give them 5,000 naira. Even if your pocket money, you keep on increasing. By the time you get to 40, you must have even built enough. Then that is when now you start allocating. Even these pension schemes, contribute pension schemes, was just asking me, let them give me my money, let them give me, I want to take it. I said, no, they cannot give you that money according to act. if you're up to 50 years, you understand, their PFA can only give you part of it. And the other one, he will now such a way that he can give you that monthly salary that you were earning. That is it. Because they give you, maybe some of them you can use it and go and if you have one, you can go and marry again. So because you have that money.
but I mean, as we bring this one, because we need to end in like 10 minutes. So in a nutshell, what you're saying is that the idea, the mentality we had in the 60s, 70s, 80s, where the only investment strategy parents had was to give their children better life and wait for the kids to grow up and take care of them. That investment strategy, that era
has gone.
It's gone.
Yeah. You don't do that.
It's gone.
You don't do that. You have options. That's what we are saying. You have options.
You can have that idea all you want till your child tells you, Daddy, sorry, I'm not taking care of you.
Or your child doesn't get a job.
Exactly. What if your child is not even successful, right?
Especially if it is a male child where he has to battle with his own family. So anyway, you see, as young as you are, you just start saving. So when you talk of investment for retirement, people think it's only when you have retired. No, it's not. So
to wrap up, I have one last question, really.
In 30 seconds.
Yeah. So all this is outside the contribution scheme.
Yeah. They're outside the contribution scheme.
Okay, so what do you have to say about that, really? What in regards to what do you have to say about the scheme itself? Really?
Like I said it earlier, the scheme is very, very wonderful. I think one of the best policies Passenger they introduced. It's very, very good. If you are working, that means you are saving. And going into your retirement service account.
At least you are guaranteed.
Yes, you are guaranteed. Once you come out, you can now access it. You can either use it to do what we call program withdrawal. That is your pension fund administrator will administer that one. Or use that money and buy life annuity. Give it to insurance company. Insurance company will not give you life annuity. That means they pay you till the rest of your life.
Okay. All right. So let's bring this home. So thank you everybody out there listening. And I advise you all go to the Nairametrics YouTube page and watch this video again. Besides saving for retirement, you also need to strategize to give you longevity. And we'll call it a day. It's been Everyday Money Matters. Thank you very much for helping us break this down. We look forward to seeing you next week, everyone. Take care. Bye.